Yep.
Hey, Drew, welcome to the show today.
Thank you, Michael. Glad to be here as always. Good to be talking on a very important topic together.
Yeah, so I really want to talk about kind of the role that stocks and real estate play in a portfolio. And if you study the portfolio allocation of multimillionaires, a quarter of it is in real estate. But there's a lot in other things like private equity and stocks and things of that nature. So I really want to talk about that and really shine a light a little bit on stocks as well, because man, they've been on a tear lately. And a lot of people are scratching their head going, are we in a bubble? Should I put more in? And
hmm
that kind of stuff. And there's a lot of things I think that I know or people know about the stock market, and then maybe some things that they don't know. And the same thing goes for real estate, frankly, right? And so I kind of want to shine a light on that. So I want to kind of start with the stock market. What role should stocks, equities, maybe even bonds to some degree, play in an investor's portfolio?
Yeah. I mean, the stocks and you mentioned bonds, right? These things should play a fundamental role in people's investment portfolio. Depends on your age, depends on your risk tolerance, but at a very high level, you're buying ownership in some of the greatest companies in the world, and that's a smart thing to do, right? So I have always had a good amount of my investments in equities, in corporate ownership. That's a great thing to do. Over the decades, uh, stocks have done very well, right? They average something like 8% a year over the decades. And if you look at those charts where it's like, hey, if you put $1,000 in every month, where does it end up over time? And you put it in equities compared to keeping it in cash, you'll on balance do a lot better, right? So people get scared about what's the risk of putting their money into a certain asset class. But the other question is, what's the risk of not doing it and keeping it in cash or keeping it, under your proverbial pillow? That's the bigger risk, right? And so stocks have always been an important part of everyone's portfolio, and it should be something that everyone does. Right now, where exactly in the market do you put it? That's a different conversation. But it's important. It should be there, and I'm not one to knock it.
So should one pick individual stocks? Should one just buy an S&P 500 index fund to diversify a little bit? Like what's a good strategy there?
Yeah, right. No, you should not pick individual stocks other than with your fund money, right? If you're like, gosh, I just love Cheerios and I want to buy General Mills stock, go and do it, right? That's fine. That's fun. But fundamentally, if you're buying individual stocks, you're saying, I'm smarter than the people that do this full time on Wall Street and have access to the best information. And that's a lot of hubris. Like you really got to think you're smart to know better than the market. In contrast, I'm a big believer in buying sort of a basket of the businesses. You'll never know which business is going to rocket up this year versus next year. And so buying something like an ETF, like a mutual fund that kind of gets a little bit of a broad spectrum of the market is like what I would generally do. It also allows you to sleep a lot better at night, right? You don't have all your eggs in one basket. In general, although that's a lot less true today than it used to be. Buying an ETF,
Yeah, like you buy
nowadays, go ahead. What's that?
the S&P or something.
Yeah, you buy an S&P, and what's happened is we've seen nowadays a certain segment of the tech companies grow to huge valuations. I just saw this morning that Nvidia is going to be the first company at a $5 trillion valuation, right? And it was just a couple years ago that the first company ever passed $1 trillion. And now we're at five as of this morning, right? So there's a subset of companies that have grown in tremendous valuation. And the point of that is that even if you're buying the S&P 500, I think the top seven companies are 30% of the value of the entire top 500 companies. So there is less diversification nowadays than there used to be. So on the one hand, that's one reason to buy the S&P, but one should know that you have not tied a bow on the idea of diversifying your money simply by doing that.
I gotcha. So you're actually getting less diversification than we were as recent as 5 years ago. Thinking
Yeah,
that we're
yes.
actually less diversified. So if you're talking about like Amazon and these whatever Nvidia, they're Apple, right? I mean they're
Yes.
they're not really like in different industries and different verticals. So if one goes down, they're probably going to all go down.
Yeah. Yeah. All the trillion dollar companies, by the way, they're all on the West Coast. right? They are I think there's no $1 trillion company east of the
Pointer.
Mississippi.
That's an interesting conversation.
But they're all in tech. They're all in tech, and they all sink or swim together,
Right,
right? They all kind of do this. They are birds of a feather. And so it's been a great run for them the last, I would say, 3, 4 years.
right.
Um, but that does not mean that they will not all have a rough patch at some
Well,
point.
it's a good point. I mean, the S&P has been on a run the last three years. There's no question, right? So people were like, oh, I don't want to get in the stock market. They missed out now.
Yep.
And so that certainly is true. Now, at the same time, though, I mean, one of the reasons that we invest in real estate is the cash flow, right? I mean, you don't really get much in stocks. Is that true, or is that not true? Because you can have like dividend paying stocks and that kind of stuff.
Yeah, that is true, right? So there's a term called the dividend kings. And these are companies. I was actually just looking at this the other week. Companies that have increased their dividend 10% or more each year for the last 10 years. So that sounds really good, right? And those are ones that people pursue if they're really focusing on cash flow. I looked just this past week at the dividend kings. Their dividend yields right now are averaging around 2%.
Mm.
So their dividends are going up, but the price of the stocks are going up faster so that the yield is really quite low. So if you're someone who's saying, hey, for every $1,000 that I want to invest, I want to get some cash flow out of it, even those stocks that are the kings of dividends are not doing a great job of producing a lot of yield, a lot of cash flow for you because their valuations have gone up so much. So it's a real kind of quandary for cash flow investors to find that in the stock market.
Yeah, and the other reason we invest in real estate obviously is for tax advantages, which you don't really have with stocks. You're paying short-term, long-term capital gain every time you have to sell something. And that's not really factored in that you said 8% return over the decades.
Correct.
Somewhere between 8 and 10 is the numbers that depending on which decades you take. But be that as it may, 8 to 10 does not include any kind of tax that you have to pay on it. And so, and this is why a lot of people are attracted to real estate as well, to kind of offset that little bit here. But again, I mean, just staying out of the stock market, saying, oh, you should just invest all your money in real estate is not prudent either, because you
Yep.
would have missed out this last 3+ years run up. I mean, it was an incredible run up that we've had. But the question is, everything is a market cycle, right? So, like, where do you think we are on the stock market on a market cycle, and kind of what is your outlook? What are you seeing there?
Yeah. So I mean, my own opinion is that the stock market is highly valued, right? And so, just like every other asset class, it has its ups and its downs, it has its seasons, it has its cycles. If you look at the valuation of the stock market right now, there's something called the CAPE, the cyclically adjusted price earnings ratio, right? So you can type in CAPE and you'll find it on the internet. But the ratio right now is at 39, which basically means you have to pay $39 of investment to get $1 of earnings per share, right? Today in the stock market. The historical average is 17, right? So you're paying twice as much for $1 of cash flow today versus the average, which is a way of saying, hey, it's probably toward the top of a valuation cycle. And then there's times where it's down below 17. Um, and so that can give someone pause, right? I have personally thought about, I haven't done this at this point, but I've thought about selling a big portion of my stocks because I feel right now like, hey, I've had a really good run. It's been really great, but how long is the party going to last? When are they going to kind of take the spiked punch bowl out of the party? And that's what I'm thinking about.
Yeah, so I think, I mean, that's the way I think about it, is you dollar cost average into the stock market, right? Because that way you're getting that part of the asset allocation, whether a market's going up or down. I mean, that's probably the best strategy rather than trying to time the market.
It's really good, right? If there's also, I know a lot about these charts, but there's charts that say, hey, if you dollar cost averaged, you put in the same amount every single month for the last 10 years. But then let's just say that out of the last 10 years, 120 months, you only missed 5 months, but they're the 5 best months. Your overall return would go from, call it a 300% return down to 150% just by missing those few times because you failed to invest consistently. You thought you were smarter than the market. You thought you could outbet those guys on Wall Street. And by doing that, you missed out on the best return. So being consistent and not thinking that you know better than everyone else is sort of this humble approach that generally gets the best returns on the stock side.
Right. So from an asset allocation perspective, like I said, multimillionaires are invested 25% in real estate, and they really do it for probably three reasons. One is it's a non-correlated asset to typically these tech stocks. So you're invested in real estate, and it depends a little bit on what real estate you're invested in. Are you in residential real estate? Are you in office? Are you retail? Are you multifamily? Right. So mobile home parks. And so they're all in a separate market cycle. I mean, they can be related, but just looking over the last decades, they're not necessarily correlated, right? So for example, in a recession, mobile home parks could actually be up because people are looking for a more affordable place to work. So spreading out across the real estate is actually not a bad idea. And if you look at the historical appreciation of real estate, it's actually much higher than with stocks. And the other thing it does provide that cash flow. So rental income, which is missing from stocks as well. And then the taxes. The taxes are they've always been huge, the tax advantage, but now with bonus depreciation back 100%, it's we've seen a lot of people get off the sidelines and get back into real estate because bonus depreciation is back in play. I think last year was 60%, which is that's pretty good, but not nearly as good as 100%. I mean, you can write off 100% of your investment in your first year. That's crazy. Right. And the only thing that's better is an oil and gas investment because you can actually do the same thing, but then offset active income versus just passive income. So there's a lot of reasons that people want to be in real estate. And I think this is where people struggle. I think a lot of people, they feel like to get in real estate, they'll buy a rental property. Right. And then they discover, oh my gosh, this rental property makes $200 a month and it's a pain in the ass.
Yeah.
And like, okay, now I'm in real estate and I got some tax advantage, but it's not even making a dent in my income or the tax benefits I'm looking for. And so they really kind of struggle with that and how to get in. Now there's turnkeys. There's a number of people that we know there's turnkey companies and you buy the house and they manage everything. And that is actually pretty cool, except for when the turnkey operator, the property management company, has struggles with managing that house. Maybe if you've seen people struggle with turnkeys as well. And so now it's not nearly as passive as it maybe was set up to be. And so what does that leave, right? And so now you're talking about investing passively as an LP. So let's talk about that briefly because I think a lot of people on this call probably know what that is. But what does it mean briefly to invest passively as an LP in commercial real estate?
Yeah, I mean, it is very similar to investing in the stock market, as we just talked about, in the sense that you are saying, hey, I'm not going to try to do this on my own. I'm not going to go create my own company, or I'm not going to go buy my own large apartment building. I'm going to put my money with people who do this day by day and who are professionals in this space. So if you're investing as a limited partner in a deal, you're saying, hey, I'm going to put my money as one part of the overall package, and together we're going to team up, buy a larger asset and get those cash flows and get those tax benefits without being the person that gets the phone call about the toilet that's not working at 11 o'clock at night, right? You're passive, you're limited as a partner, but you're still getting the benefit of working with a larger organization.
Yeah, and that works. I think the critical thing is that I think most of our investors are not just invested with us or even just invested in one asset class. They will invest in different asset classes, like I said, mobile home park or self-storage, because a lot of times these are non-correlated asset classes, real estate asset classes.
Yep.
And the key though is to really invest with operators who have a big track record, who've been around for a while, have navigated some tough market cycles. And if you can find those kind of operators, you have a good chance of getting consistent returns in that asset class. And that's really kind of what we've strived to do at Nighthawk. And so let's talk about the outlook though. Let's talk about outlook for multifamily. Um,
Yep.
what is kind of your outlook for multifamily? It's been kind of down, I'd say, over the last 2.5 years. We had a huge run up in valuations, and people were jumping in, and the kind of market peaked a little bit. Interest rates run up, which is never good for real estate. And so now they've kind of stabilized at a higher point.
Right.
What is your outlook for interest rates, but even for demand for multifamily? Like what's your outlook for the asset class in general?
Yeah, I was just reading a lot on this question. I kind of always am, right? But someone had a very interesting point. There's all these data points: job creation, inflation, cost of labor, cost of insurance. All of these might go up, they might go down. It's really hard to know. There's one thing that is a huge driver of how the asset class will go. And fortunately, we can basically see 24 months directly into the future. And that is development of new apartment units. We can see right now, based upon permits that have been given and projects that have begun, where dirt has begun to move, where we will be 24 to 36 months out in apartment deliveries. You can just go look at it. You can drive around. And we have the inverse of where we were at 3 years ago. 3 years ago, right? Apartment rents were up through the roof and money was cheap. So every developer's like, I'm going to go build 5 apartment buildings. And by golly, they did, right? And now here we are with a lot of excess inventory that we are working through right now. But now they've just swerved the car from the left ditch of the road over to the right ditch, right? And that's good for us because now they're like, holy cow, money's expensive to borrow and rents aren't going up. So no one is effectively building anything right now. We can see that, right? And so people will continue to have babies, right? Household formation will continue to happen. So there will be ongoing demand for more apartment units, but the supply is constrained. So what we're seeing is a return to equilibrium and probably slow pricing power back to the landlords. So the pendulum's swinging back. That's what I see happening. Nowhere like what we saw in COVID, which was crazy, but kind of the middle spot where you want it to be.
Now, the unknown is, and there's some data coming out now, is the employment rate, specifically for young adults, graduates who are struggling to find jobs. I think the unemployment rate is double what the normal unemployment is, like 9.2 versus whatever the half is. And so it's a little bit of an unknown about the absorption of these. You're right, there of these all these apartment buildings that they're no longer coming out of the ground, but it looks like demand might soften just a little bit. If they can't find a job, then they're going to move back with their parents, for example. So there's a little bit of an unknown about the absorption rates of all this stuff that was built over the last two years,
Mhm.
and so I think we just have to be a little bit conservative in our rent projections. I mean, back in the day when rents were running up literally 25% in one year, we were still underwriting with 2.5%, which in hindsight was probably a bit of a mistake because we probably lost some deals. But then when things stabilize, you can't be underwriting stuff at 10% rent growth anymore. So we're all going to have to underwrite with more normalized rent growth, whatever that is, 2.5% more of a normal market. We can't expect that rents are going to shoot through the roof just because the new housing units are not coming out of the ground. We have to
Right.
watch it carefully.
Yeah, yeah. I mean, listen, unless culturally people get really happy with being 22-year-old and living in their mom and dad's roof, we will continue to see household formation. There'll be blips like what you just spoke about, but fundamentally, people want to go live on their own, right? That's kind of the American way, right? Other cultures do it differently. So, yeah, we have some concerns about unemployment right now. That might slow down some people moving out under their own home. But fundamentally, I think it's going to continue to happen, right? Um, so I'm not too worried about that in the 5 year outlook, maybe in the next 12 months, but no one can really predict the next 12 months. What you want to look at is sort of 5 year trends.
Let's pivot a little bit to private equity because if you study the portfolio allocation for multimillionaires, billionaires, there's a good chunk. I can't remember, but it's probably close to 20-25% also in private equity. And
Yep.
this is really typically only if you're a really high, ultra high net worth investor do you have even access. These are private companies that someone has these private offerings that you have access to. And I think that's really changing. I think this is a trend that's been slowly changing, I would say, over the last 2 to 3 years, where essentially you can buy into like a larger apartment building, you can buy into a service-based business. And this
Mhm.
is something that we've been looking at. In fact, we're doing more at Nighthawk Equity. We're actually doing more than that and looking into. We're actually looking for deals to purchase. We want to acquire a services-based business. I'm talking about something like assisted living or commercial, residential HVAC, roofing, things like that. And what's interesting about that? Well, what is interesting about that, Drew? Before I go on, but why is it that we're looking in, and why is that interesting for investors, and why that's important to be in someone's portfolio?
Yeah. I mean, it has a very attractive risk return profile, right? That's the short answer. And then, a little bit more about it is that they simply produce a lot of cash for every dollar of ownership, right? If you wanted to, you were talking about that ratio before. If you wanted to buy $1 of cash flow in an operating business, it might be half the price of buying it in real estate, or in a very mature S&P 500 type company, right? So because of that, you can buy a really good cash flow stream. Um, without putting out millions and millions of dollars and without taking out maybe a lot of debt, right? So you have lower leverage, and that really helps you control your destiny. And
Definitely.
these are not exotic businesses. These are sort of very everyday, must happen, not going to be beaten by AI type companies. These are blue collar jobs kind of things.
Yeah, that's exactly right. I mean, I think you're talking about, you can buy, a revenue stream for 3 to 5 times the income stream, the profit stream, EBITDA, right? Which is crazy. Like the equivalent multifamily would be 25x, right? So so the valuation is much, much lower for the service-based business. Now, on the other hand, though, the operational risk goes up, right? Because someone's got to run the company. I think one of the main advantages of multifamily is you can choose with one of a dozen professional property management companies and hand them the keys. If they don't work out, then you hand the keys to somebody else, right? And it's a little more difficult to do that for an operating from an operating business because there has to be a person running that company. I can't just call up 6 people and have that company run. So to me, there's a little bit more of an operational risk to run that company.
Yeah, I mean, I think you and I have talked about this. I see it a little bit differently, right? I think it's challenging to find an operator for any type of business, right? And that is the key to your success. You and I have worked with different operators of apartment buildings, and not all that glitters as gold, right? And so it's been a hard fought fight to find good managers for apartment buildings. I think we made a lot of progress there. But yeah, it is definitely true that when you're buying an operating business, you better be very you better think a lot about what you're going to do the day after you close and own that because there's no one that's going to just parachute in and do it for you.
Now, the advantage of it, as you talked about, is the IRR and the cash on cash specifically is much higher than anything you can do, higher than stocks, higher than multifamily. You don't get the tax advantages though. That's the downside. So you're pulling full on, capital gains taxes on anything that you get back from that. But the returns are very healthy, and therefore this is why people invest in private equity. It's a little riskier, I would say, just because an operating business could theoretically go to zero. Like a multifamily probably can't go to zero from an evaluation perspective as a real asset. But again, the returns are very attractive, and I think this is something that we want to add to our portfolio and offer to our investors as well because it's a totally different asset class.
It's another leg in the stool, right? So I think stocks and bonds, one category, um, commercial real estate being another one, and then private equity being a third, right? And that's what I know you and I have known each other for a decade now, right? That's what you and I have been doing personally as we've been sort of studying how wealth gets made, how wealth gets defended, how do you be smart, how do you be nimble in a changing market, and all three have their merits, right? And any portfolio without all three, I think also is not as defensible as it should be.
So we wanted to shine a light really on kind of the 3 major asset classes that should be in your portfolio. And, over time, Nighthawk Equity Investment Firm is going to strive to provide you high quality investments in those areas. And next for us is private equity. We've aligned ourselves with advisors and building a team around that and looking at probably hundreds of deals before we decide to pull the trigger on something. And we're only going to do it when we have the team in place. So, but I'm excited about it. I love operating companies, and I think it's a really exciting addition to the portfolio. So Drew, thanks for being on here and chatting about asset classes.
You bet. Glad to be here, Michael. Thanks.